Hi, welcome back to Academic Markets Insight. This is the third video in a series of brand new topics. So I'm very excited about this because these are all brand new topics to me. And today's is auto-callable ETFs. So with that, I'm going to pass this over to Dr. Rowe for us to get started because I'm super curious. What is an auto-callable exchange traded fund?
Yeah, and I think people even that aren't heavily involved in the derivative industry are familiar or have heard the term autocallable. And an autocallable ETF is basically an ETF that gives you exposure to a portfolio of autocallable notes. So that's it. And thank you for joining us. No, there's a lot more to it than that. So the ETFs, they offer a payout structure that was previously, you could only get it through an autocallable. And an autocallable is kind of a bond-like instrument that gives returns based on what's going on in mostly in an equity index. I've actually found autocallables based on gold and oil lately. But the autocallable ETFs, they focus on stock indexes. These are relatively new. There was a gentleman from Calamos that was on I think he was on a panel and talked about their introduction of the Calamos Autocallable Income ETF. And Calamos, I think they're very well known within Chicago. And Mr. Calamos, he was kind of like associated with convertible securities, kind of like I'm associated with VIX. I mean, that was, kind of his thing. So they're very experienced in instruments that have equity-like and bond-like payoffs. So I think they're uniquely qualified to be first to market on the autocallable income ETF. And as noted, basically an autocallable ETF is going to offer exposure to a portfolio of autocallable structured notes. And those structured notes are linked to a market index. So the Calamos Autocallable Income ETF market cap is at $850 million. It has not been around for a full year. That is a really successful ETF launch. There's the ticker CAIE, and there's not just one, but this is the one that this autocallable ETF is supposed to be following. There's a firm called Mercube that does a handful of autocallable indexes, and this one follows the large cap vol advantage autocallable index, and follows it pretty closely, I believe. Yes.
Yes, for our number one fan, you had commented that the market cap is $850 million, and that's indicated that this was a successful ETF. Why does that mean that it was successful?
The amount of funds under management, I don't think any of the volatility related ones have $850 million now. There are a lot of different niche ones that would be in the tens of millions and be considered somewhat successful. So it's really just a matter of the amount of capital under management. And the way the ETF providers get paid, it's a percentage of assets under management. I would love to get, I'm not sure what the management fee is, I feel like it's probably around 0.5 or something like that because this is an actively managed fund. But still, I would love to receive a very small percentage of $850 million every year. So that's really the AUM and how quickly it's grown. I'm not really sure if there are many other ETFs that have gotten that close to $1 billion in 10 months.
Right.
10 months. So, and the index performance, this Mercube index, even though these ETFs just, the first one is less than a year old, this index goes back a couple of decades. So we can see what the performance would look like. This index goes back to the last day of June 2005. And just for display purposes, I put $100 in this autocallable index and $100 in the S&P 500 total return, which would include reinvesting the dividends. And you can see that there are a few periods where the Mercube index outperforms. Typically, that outperformance occurs when we get a sell-off in the S&P 500. And you can see that's 2020 was probably the last time that they separated, and they've come back together. Currently, long-term performance, there's just $100 in each would get you up to around $800 or so, and I think the difference is maybe $10. So they're pretty much in line, and it does appear that in line and less volatility during volatile periods, like a better place to be during volatile periods than the S&P 500. And before I try to describe the ETF, I'm going to give you an example of what an autocallable note might be. Just created one out of thin air. The 3-year time frame seems to be pretty common. I made this one with semi-annual call dates. A lot of descriptions I'd seen had annual call dates. As I started to dig, I found more and more semi-annual ones. So the underlying S&P 500 index, that would be where the S&P 500 was when this is issued. So I just made up a nice round number of 7,000. And the coupon, which is paid as a conditional payout, would be 4% semi-annually. The autocallable barrier is the same as where the index was when this was issued. And the downside barrier, which impacts two of the possible income streams, is 4,900. And as long as the autocallable stays above 4,900, we're pretty safe with respect to this instrument. Our real risk, there's an opportunity cost to the upside, but the real risk is that downside barrier of 4,900. So at the first 6-month observation date, if the S&P 500 is above 7,000, the note can be called early and you receive your principal and a coupon. Just to keep it simple, let's say that the note was $1,000, you would get $1,040. So now, if the S&P 500 is less than 7,000, but greater than 4,900, we receive that 4% coupon. If the S&P 500 is below 4,900, we don't receive our coupon. So that's why that down 30%, sometimes it's down 10 or 20%, depending on the structure. But that's why that level is so important. And then finally, at maturity, if the S&P 500, if we make it through the full 3 years without it being called early, if the S&P 500 is greater than 4,900, we receive our principal and the final coupon, even though the stock market has gone down. This is where it gets a little technical. If the S&P 500 is below 4,900, we receive some of our principal back based on losses. So I put the S&P 500 at 4,000, which is down around 43% from that 7,000 level. And what we would receive is we would receive only 57% of principal. That would equate a loss of 43% on the index. So if we breach that downside level, we realize all the potential losses of that downside level. That's the big risk with an autocallable note. Also, just receiving 4% when the stock market's gone up 20%, that could be considered a loss of the opportunity cost as well. So an autocallable ETF is just going to hold a portfolio of these. And that first mover, the one from Calamos, CAIE, I think it's better than that long title. They have exposure to several, I think 50 or so when you start to dig through. And just performance-wise, since the June 2025 launch, the performance has slightly lagged the S&P 500. It's like the S&P 500 is up around 8%, and this autocallable is up like 7.5% or something along those lines. So with that, unless you got some questions on this, it's describing it at a very high level.
Right.
One of those things that if you're thinking about investing in them, definitely do a bit more homework. Uh, but with that, you can ask everybody to say nice things and follow us.
Yes. We thank you so much for hanging with us for this video. And if you liked it, please hit thumbs up. And if you're not already a subscriber, please hit subscribe. And again, we are very open to constructive criticism and suggested topics. We wish everybody a happy, happy day whenever you're watching this. Thank you.
Thank you.